Buy a stock one day too late, and the dividend goes to the person who sold it to you. Not delayed, not prorated, gone to somebody else. That's the ex-dividend date doing its job, and it's the single most consequential of the 4 dates attached to any dividend. Most people learn the 4 names and never learn which one actually decides anything, which is exactly what the exam checks. And it checks it in a way that looks like a memory question and is really a comprehension question. Anybody can list 4 dates. The item is asking which one a buyer has to be on the right side of, and that's a different thing entirely. And there's one kind of dividend where that date doesn't sit where you expect it at all. It arrives after the money does, which sounds impossible until you see why. We will get there.
Start with the 4 dates in order because the sequence is the whole map. The declaration date is when the company announces it intends to pay. The ex-dividend date is the cutoff that decides entitlement. The record date is the day you have to be on the company's books. The payable date is when the cash actually reaches you.
Announce, cut off, check the books, pay, 4 steps, and only one of them decides anything for a buyer. The other 3 are the company keeping its own diary.
And the entitlement rule is stated bluntly by the regulator, which is helpful because there's no room to misread it. If you purchase a stock on its ex-dividend date or after, you won't receive the next dividend payment. Instead, the seller gets the dividend. On or after. Not after. The ex-date itself is already too late, which is a genuinely counterintuitive piece of wording because most cutoffs in ordinary life include the day they name. A deadline of Friday usually means Friday still works. This one doesn't, and the phrase on or after is the whole reason.
Erica, why does the record date exist separately then if the ex-date is the one that decides?
Because the company has to look at a list on some particular day. Somebody has to read the register.
That's exactly it. When a company declares a dividend, it sets a record date when you must be on the company's books as a shareholder to receive the dividend. The record date is the company's administrative moment, the day it reads the register. The ex-date is the market's answer to a different question, which is who a trade today will leave on that register. So they're answering different questions and they belong to different parties. The record date belongs to the issuer and its transfer agent. The ex-date belongs to the market, and it exists to translate the issuer administrative deadline into an instruction a trader can act on today.
And that relationship is where something recently changed.
It changed, and it changed for a reason you already know from the last episode. The ex-date is derived from settlement. It has to sit far enough ahead of the record date that a buyer's trade actually settles in time to put them on the register. Shorten settlement and the ex-date slides later. So under the amended rule, the ex-dividend date is the record date itself, when the record date falls on a business day.
Erica, they're the same day now? That collapses 2 of the 4 dates onto each other.
For a regular cash distribution, yes. And if the record date happens to fall on a day designated as a non-delivery date, the ex-date is the first business day preceding it. Those amendments became operative on May 28, 2024. The same day settlement moved to 1 business day because the 2 changes are the same change viewed from different ends. Which is why learning them as 2 separate facts is harder than learning them as one. The ex-date is downstream of settlement, so it will move again the next time settlement does, and anybody who understood the reason won't need to be told.
Which means a study guide written before that date has the ex-date in the wrong place, and it's where I'd leave scene 1. If you want to drill these 4 dates until the order is automatic, there are free practice questions and study material for the whole exam at certs.richresourceful.com. Before we keep going, one small favor that actually moves the needle. If this is landing for you, tap like, then subscribe and turn on the bell so you do not miss the rest. 2 taps, completely free, and it pushes this in front of more people who need it. Professor Nakamura, don't give me the general rule. Narrow it. When somebody applies what they know about a cash dividend to a stock dividend, what breaks?
Depends which half they carry over. Pick one, the entitlement logic, or the position of the ex-date in the sequence, because one of those transfers and the other inverts.
The position. That's the one that sounds impossible.
Then here's the sentence people don't believe on first reading. For a stock dividend, the ex-dividend date is set the first business day after the stock dividend is paid, and it's also after the record date. So the ordinary sequence you just learned is turned around. The shares are distributed, and only then does the ex-date arrive. And I'd emphasize that this isn't an obscure edge case dropped into the rulebook. Stock dividends are common enough that anybody working with retail accounts will meet one, and the sequence catches people who are otherwise completely comfortable with the cash version.
The ex-date comes last. That's genuinely backwards from the cash version. I'd have got that wrong under time pressure.
And Professor Nakamura, this is the part I want to be careful about for anybody watching, because it would be easy to hear that as the rule being inconsistent for no reason.
Erica, hold on. Is it not inconsistent though?
That's what I was about to argue, and I want to get it right rather than fast. Let me come back to it.
Take the time. The reason is the interesting part.
Right, and here's the correction I owed you. It's not inconsistent, it's the same principle producing a different answer, because the thing being distributed is different. With cash, the share keeps existing unchanged and the cash leaves separately. With a stock dividend, the shares themselves multiply, so the price per share has to adjust, and the market can't mark that adjustment until the new shares actually exist. The ex-date is when the price adjusts. That's why it waits.
That's the correction I wanted, and it makes the inversion feel inevitable rather than arbitrary.
And there's a practical consequence that follows straight from it, which questions do reach for. If you sell shares before the ex-dividend date for a stock dividend, you're obligated to deliver the additional shares acquired from that dividend to the buyer. You sold the position including the entitlement, so the extra shares travel with it.
So the new shares follow the sale rather than staying with the seller. Which feels unfair until you see the pricing.
They follow the trade because until the ex-date, the market is still pricing the shares as carrying that distribution. Anything else would let somebody sell the same value twice. And that's the test I'd apply to any entitlement question on this outline. Ask whether the proposed answer would let one economic benefit be claimed by two people. If it would, it's the wrong answer because the rules are built precisely to stop that.
And there's a threshold hiding in all of this that decides which set of rules applies.
And it's worth carrying. For these purposes, a regular distribution is one valued at less than 25% of the value of the security. Cross that line and the distribution is treated under the other set of provisions rather than the ordinary ones. So 25% isn't a rounding convention, it's a switch between two regimes.
Which is the sort of number that only ever appears if you read the rule rather than a summary of it.
Professor Nakamura, thank you for making the inversion make sense.
Though you never did say which half people usually carry over wrongly.
The half they were taught first. Ask me a sharper question next time and you'll get there sooner.
So the last group is the actions that change the shares themselves rather than paying anything out. And there's one question that answers most of them.
The question is what actually changed for the holder, and for a split the honest answer is almost nothing. A forward split gives you more shares at a proportionally lower price. A reverse split gives you fewer shares at a proportionally higher price. Your total market value is unchanged and your percentage of the company is unchanged. And it's worth saying the arithmetic out loud once because seeing it kills the intuition that something happened. A holder with 100 shares at $60 has $6,000. After a 2-for-1 split, they have 200 shares at $30, which is $6,000. Nothing was created, nothing was distributed, and the company is worth precisely what it was worth a moment earlier.
More slices of the same pie. The pie didn't get bigger. Nobody got fed any better.
And that's the whole of it mathematically, which is why the exam tends to test whether you believe it rather than whether you can compute it. A candidate who thinks a 2-for-1 split made the holder wealthier has misunderstood something fundamental, and a question can check that in one line without any arithmetic at all. It can simply describe a split and ask what happened to the holder position, and the correct answer will be some version of nothing of substance. Candidates who expect every question to require a calculation talk themselves out of that answer because it feels too easy.
Leo, so why do companies bother?
To move the share price into a range people find easier to buy. It's a marketing decision more than a financial one.
Which is a real reason even though it changes nothing about the underlying value. A very high price per share can put off smaller buyers, and a very low one can look distressed or fall below an exchange listing threshold. So a split is largely cosmetic in substance and occasionally consequential in effect, and holding both of those thoughts at once is the mature position rather than dismissing it as meaningless. A split doesn't change value, and it can still change who is willing to buy, and both of those statements are true at the same time. The exam wants the first one. A customer conversation needs the second one as well, and knowing which context you're in is part of doing this job rather than only passing about it.
Erica, and the other actions on this outline, tenders and mergers are a different shape.
There, and the same question still does most of the work. A tender offer is somebody offering to buy shares from holders directly, usually at a premium to the market, and the holder's decision is simply whether to accept. A merger changes what you own into something else, either shares in the combined company or cash or both. In each case, ask what the holder ends up holding and whether they had a choice about it. That second half is the one people forget. A tender offer is voluntary, so the holder decides and can simply decline. A merger is generally not, so the holder ends up with whatever the terms specify whether they like it or not. Voluntary against mandatory is the axis that separates those two, and it's a cleaner way to hold them than remembering definitions.
And that framing carries across the whole topic.
It does, and it's the useful thing to leave with. Every corporate action on this outline is answering one of two questions. Either who is entitled to something being paid out, which is the dates, or what does the holder end up with, which is the splits and tenders and mergers. Sort the action into one of those two, and the answer is usually already in front of you. And that's worth more than the individual rules, because this outline will keep handing you corporate actions you haven't specifically studied. A framework that sorts an unfamiliar action into a familiar question is the thing that gets you through those, and it's why this episode spent its time on why the dates sit where they do rather than on a list to memorize.
Tiffany, one last thing for anybody sitting this soon. When a question gives you a dividend and a date, don't reach for the 4 names. Ask whether the buyer's trade puts them on the register in time. That single question regenerates the ex-date rule instead of making you recall it, and it survives the next time settlement changes.
That's where I'd leave it. This corner rewards understanding why the dates sit where they do, because the where has already moved once in recent memory. If that helped, a like genuinely helps other people find the series, and subscribing puts the next episode in front of you while this is still fresh. I will go first on this one. The thing I had backwards for years was assuming the record date was the one that mattered to me as a buyer, when it's the X date that decides and the record date is the company's paperwork. So here's my question to you. What's something you thought was about you that turned out to be somebody else's admin? Have a think, because this exam is full of them. I'm Tiffany, and I will see you in the next one.